sensible spending. No one has listened to me for the last 30 years.
All right, Bitcoin. We have a panel on the future of Bitcoin. Before that, we'll have a look at a short video. This video has been produced by designer Duncan Elms, who is in New York City, and it's written by an Australian journalist, Mark Fennell, and we already had it in the Web London, and I find it very good to explain what Bitcoin is. So let's have a look at this video.
The world is in financial disarray, currencies failing, economies in wild flux, jobs being lost. But what if you could build an entirely new economy, one specifically designed for the digital realm? Well, that is the dream behind Bitcoin. Bitcoin is a decentralized electronic cash system that uses peer-to-peer networking along with digital signatures and cryptographics to generate currency. Now, with traditional money, think dollars, the euro, pesos, you've got a central bank, like the Federal Reserve. They issue the currency and they print more or less cash as needed, but not with Bitcoin. Bitcoins are generated using a process called mining. Your computer is given a complex mathematical problem to solve, and the goal is a 64-digit number. If your grey box can successfully solve that algorithm, then congratulations, you are the proud owner of a new block of 50 Bitcoins. The network automatically adjusts the difficulty of mining so that 50 Bitcoins are created roughly every 10 minutes. The reason they call it mining is because there's a set number of Bitcoins that can ever be mined in the system. There's only 21 million Bitcoins that will ever be created in total. You can't just print off cash like they do in the real world. You're digging it out of the system like precious metals from some mathematical mine. Right now, a Bitcoin is roughly worth $70 US. Last year, miners generated the equivalent of $16.7 million worth of Bitcoins, and we're only halfway down the mine shaft with over 10 million Bitcoins unearthed already. Like any economy, you don't want too much too fast, because then the value of your currency drops, or so slow that your economy grounds to a halt. It's designed to be a self-stabilizing economy. Whether it actually is that way though, well, that is a little bit more complicated. Welcome to the exchanges. These exchanges allow people to buy and sell Bitcoins with each other. The largest Bitcoin exchange is Mt. Gox. And it's here that you can purchase Bitcoins using local currencies. You can even store Bitcoins too. Mind you, that can be a bit risky. Hackers have, on occasion, dangerously destabilized these exchanges. Bitcoin is also the currency that fuels what's known as the dark web. Using software called Tor, you can hide your identity online and access the digital marketplace they call the Silk Road, where sellers flog illegal drugs like LSD, heroin and marijuana. Buyers conduct all transactions using Bitcoin. The influence of Bitcoin is growing. WikiLeaks and WordPress will accept Bitcoin as cash. Even the ideas behind Bitcoin are already changing the way people think about cash. The Royal Canadian Mint have just launched Mint Chip, an electronic currency backed by the Canadian government that borrows a lot from the philosophy of Bitcoin. And ultimately, that is what's most powerful about Bitcoin. Not the coins itself, but the way it can change the way we look at, think about, and most importantly, spend our money.
It's amazing how this video is already, which is amazing, but $70 a Bitcoin, it went up to $1,000 just a few weeks ago. and Silk Road has been shut down. So that's interesting. Let me welcome the panel. James Currier, who is the co-founder of UGA Labs and curator of a great conference called NFX, is going to talk as well tomorrow. Gary Hillman, who is an economic historian at the London School of Economics. And we have Shakil Khan, that doesn't need much introduction. He was the head of special projects at Spotify, and he's the founder of CoinDesk, which is a news site dedicated to Bitcoin. Please join me on stage. Welcome. Thank you. Shaq, welcome back.
Thank you. Thank you. So this is going to be a really rapid 40 minutes. We're going to get in and through Bitcoin in that amount of time. My name is James Currier. I'm the founder of 3 successful venture-backed companies in Silicon Valley, now running a conference called NFX around network effects. And nothing is more network effecty than currencies. We're going to talk about that today. I'm also up here. Loic asked me to come in. I was on the board of Second Life for about 5 years. And we have a currency called Linden dollars, which grew to 750 million in GDP. And we were talking at the board level about 5 years ago about spinning it out as a global currency. We never did. Also started a gaming company that grew to 65 million in US dollars, but that was a virtual currency that people could spend in the game. I also own Bitcoin, so I need to make that disclosure. So today we've got Garrick Heilman with us, and Garrick is an economic historian at the London School of Economics. He's also the founder of Macro Digest, which is sort of like Bloomberg for economics. It aggregates interesting stories about economics, and he's a contributing writer to CoinDesk. And CoinDesk was founded by Shakil Khan, who's also with us. Shakil's the head of special projects at Spotify, and he's one of the earliest investors there. He's also an investor and the mentor to Nick, who you just met at Sumley. He's now the founder of CoinDesk, which is the Bloomberg for everything related to math-based currencies. So rather than have a conversation between the three of us and just sort of bang through some of the basics, you've just seen a video, but let us see if we can't get up to speed. So, in the olden days, 3,000 years ago, people were trying to exchange value, and they would use gold and silver. Notice something, that you can use this currency both for the storage of value as well as the exchange of value, and those things are different. We're going to talk about that today and how it plays out in the digital currencies we have. Then after a while, people said, wow, we have these printing presses. Let's create some paper-based currency, and we can print it out. What's interesting about printing, and the US is a good example, prior to 1863, there were literally 8,000 private entities that were printing their own money. This was a patchwork of exchange between various regions in the United States. The problem with it was counterfeiting was relatively easy, and it was just unwieldy to move 10 miles and have to use a different currency. So in 1863 in the US, for instance, they signed the Federal Currency Act, which created a fiat currency for the first time in the United States. All the other countries followed suit. In 1971, the United States came off the gold standard. Now remember, the gold standard was invented only in 1821 by Britain. The United States only got onto the gold standard in 1873. So in less than 100 years, the U.S. got on the gold standard and got off the gold standard. This is not something that's been around for 3,000 years. So then we come to digital currencies. What was the first digital currency? Arguably, it was frequent flyer miles from United, 1972. The next one we saw was and then we saw all the airlines do it. The next one we saw was in 1995 with CyberGold. 96 came eGold. 99 came Beans. These were all centralized currencies with one place where the currencies would exchange. They never got off the ground for various reasons. 2002, here comes QQ, right, with Q coins. What was different about this, that the belief in Q coins was so great, people started using their currency outside of QQ.com. which led the Chinese government in 2007 to issue laws banning that sort of use. Also in 2002 comes Linden Lab with the Linden dollar. What was different about this currency was that for the first time you could trade it externally to the environment through exchanges, just like you could trade British pounds, or you could trade whatever fiat currency you might want. 2007, we had AceBucks. Don't forget AceBucks. It was a startup that was trying to do sort of credits on Facebook, backed by Peter Thiel. Didn't work. A few years later, Facebook said, let us try it. And they tried credits, tried that for 3 years. What was interesting about this is they had such massive outreach, and they could force people to use it. Also didn't work. Same year, 2009, along comes Bitcoin. It's the first distributed cryptocurrency. Okay, so what's different about this? Boom, it's open source. The software is readable, usable, replicable. Anyone can play with it. Secondly, it's distributed. There is no central arbiter of the exchange. This is the first time this was done. Next, they figured out a clever way of getting people to maintain the electricity and the computing power to maintain a distributed network by rewarding people with currency for doing those transactions. That's the mining that you just heard about. Third, no one owns it, right? Everybody, all the other currencies to date have been owned by somebody. In this case, the founders figured out how to disappear. So it's just out there, it's part of the world. Number 6, it's a protocol. Okay, you can read it, you can write on it, you can make programmable money. And also what's interesting, especially for someone interested in network effects, is there's been this incredible groundswell about Bitcoin. Okay? This is hard to do. It's hard to create. Another thing that's happening is you're getting a lot of companies jumping in to create brand new companies to support Bitcoin, to exchange Bitcoin, to use Bitcoin. This is a chart of the number of companies that have applied to BitAngels, 120 angel group in the United States funding Bitcoin-related companies. It's growing like crazy. And of course, you've got 9 or more venture-backed companies in this space, many of which we can now trust and work with. And the last thing that's so interesting about Bitcoin, which was different, is the anonymity. And this has been the feature that has gotten the most press because it's led to a lot of shenanigans online. But all 3 of these big marketplaces for drugs and guns and whatnot are now shut down as of a few weeks ago. So that's a big difference that's occurred in the last 6 months. What are some of the events? We're almost done. We're almost through this. We're going to get to the panel. On May 2013, the Chinese national television broadcast a series of programs about Bitcoin that appeared to give tacit government approval to use Bitcoins to the Chinese. In November 12, 2013, Ben Bernanke from the Federal Reserve comes out and said, this looks pretty interesting. It's not something that we're in the business of regulating. That's a big deal. However, December 5th, just a few days ago, the PBC, the People's Bank of China, comes out and says no financial institution can use Bitcoins. Nobody can touch them from a financial perspective. But the Chinese people are allowed to use them as they want, but they're saying it's extremely risky. We don't encourage it. Subsequently, any company that's a larger public company in China that had been playing with taking Bitcoins has retracted that ability. So what is a Bitcoin worth? It was worth $70 in July. Bitcoin China took off in October, and the price started up. Bernanke makes his comments. The value of it explodes. It hits 1,200, and then the People's Bank of China makes their announcement, and it drops down to 550. It's back up to 930 as we speak. Very volatile. How many Bitcoins are there? There are now 12 million, on our way to 21. Should get there by about 2040. How much is it worth? It's about 12 billion market cap for all the Bitcoins. If you look at the about a $900, $880 price, compare that to gold, which is at 7 trillion, 630 times the amount. Where can you spend it? You can spend it all over the world, but in not that many places. Only about 1,000 places. Who's getting rich? That's always interesting. Well, it turns out there's about 99 wallets with over 8.8 million US dollars. Who's trading it? Up until a few weeks ago, it was 65% trading in China. That used to be the case. We'll see where it goes. And the last thing to mention, Bitcoin is not alone. The open source software has been taken by other folks, and there's now over 60 cryptocurrencies using variations and various brandings of this sort of thing. And you can go to coinmarketcap.com to look at many of them. And one thing to think about is that if you look at the market cap of Bitcoin, it's about 10 times number 2, which is Litecoin, and Litecoin's about 10 times number 3, which is Peercoin. That's approximate, just a way of thinking about it. Okay, so that's the end of the rush through to get us all on the same page around Bitcoin. So, back to our panelists. Gentlemen, why are we talking about this? Loic has mentioned Bitcoin in probably half the panel so far today, and now we've got this big panel. Where's the excitement coming from? Why in particular the tech community? Why in particular developing countries?
When you think about who's excited about Bitcoin, I like to think about different categories or groups. The technology folks are, of course, really excited about the really innovative cryptography and protocol that's being developed. There's exotic hardware, application-specific integrated circuits, which James showed you a picture of. On the flip side, you have governments, which are also very excited about Bitcoin. And I think of the Chinese symbol for crisis, both opportunity and danger. On the danger side, regulation concerns about money laundering, tax evasion. But on the opportunity side, governments are really interested in the kind of economic growth prospects for Bitcoin, the ability to attract new investment, new ventures. Switzerland, for example, just recently is talking about actually making Bitcoin an official currency because they see economic opportunity there in that country. So. And of course, venture capitalists and investors are very excited in Bitcoin because they're looking at a multi-trillion-dollar payments industry and seeing Bitcoin as a possible candidate to disrupt that.
And what are some of the use cases? So make this tangible for us. What are we going to see us doing with this thing? And where are we going to see it?
So one of the things which I continuously talk about, and the more I spend time looking at it, the more obvious it becomes, is the Western Union remittance model. You know, you've got somebody in London or Sweden or New York trying to send some money to somebody in the Philippines or Africa. I'm guessing if they want to send $100, I think the fee may be around $20 or 20% of that. This is the people with very little money trying to make, you know, ends meet with their family members. Why is that taking place, right? Why is that taking place? So I think if you look at overall the financial systems that are ripe for disruption, but there are some specifics, especially I think remittance is one. I think overseas trading, me wanting to buy something from a US-based website, you know, which happens now every day. The credit card transaction fees are being hit. The merchant or the business, they're being hit with, say, 3% or whatever their credit card processing fee is. But I am on top of that, I'm paying, say, $99, the exchange rate that I'm being hit. So, you know, these are just two very easy ones, and Garrett can obviously explain in far more detail, but you see that just those two alone account for billions and billions of dollars of movement in the financial system.
Right. Garrett, any others?
Well, if you think about a country like Argentina or any country that's going through or has gone through a financial crisis, I mean, you see the volatility in the price of Bitcoin, but Bitcoin is not alone in terms of currency volatility. And so you could see people wanting to move out of, say, a domestic national currency and into something like Bitcoin as a safe store of value. I mean, one of the big events for Bitcoin in 2013 was the crisis in Cyprus when there was this tax announced on depositors. And we saw the price of Bitcoin really shoot up in response to this, and people realizing, well, wait a minute, we don't just have to sit here and get liquidated, watch our euros get taxed away. We can actually maybe move into something like Bitcoin as a store of safe value. But I think it's important to recognize that there's a kind of future for Bitcoin that's different from today, where today Bitcoin is very much primarily a financial asset, as James mentioned. There aren't that many places where you can use it for merchant transactions, and but in the future we certainly could see that.
So you're saying today it's much more of a store of value, sort of like an alternative to gold, and it's not so much of a transaction currency yet. It could be, but it's not as much yet in its history of growth.
I think we need some more mainstream adoption, you know, whether it's Amazon or whether it's, you know, it's probably going to come from one of the online retailers, I think, as a starting point. if we look at where we are now, WordPress is starting to accept it. I think OkCupid, or there are a number of companies who have started embracing it, but until a household name does start accepting it, and they've got to find the relevant reasons why, and I think legislation on their part comes into it, because it'll probably be getting encouraged by the technical department who understand it, but you're a CFO of a publicly listed company, do you want that risk? And
right.
Even to the extent you don't necessarily understand it as much that you would like to, so the easy option is, hey, we're not ready for this.
Right, right. Yeah, we were talking to Silicon Valley Bank the other day, and they were saying that they're just trying to help their customers figure out how to deal with Bitcoin once they get it in the company. How does it touch the rest of the financial system? The rules aren't clear. No one knows, what their liability is, and so people are waiting right now. So, some of these things, for consumers to adopt them and for these companies to adopt them, for the board of Amazon or the board of PayPal to say, yeah, let's do this, it needs to be tangible for people. And people need to be able to feel it and trust it. How are we going to get there? What can you see over the next year that will happen that would help us get there?
So, in regards to the feeling and the touching, I'm going to go slightly off tangent here. I heard this in 2006 when Daniel Ek at Spotify, was a 22-year-old entrepreneur, said, I'm going to try and change the world. And the meetings we'd have is, and so many meetings would go into, people go, well, you don't understand, guys. I need to feel the CDs, right? I need my cover art. I have a bespoke bookshelf, a CD rack made for them, and that's where it is. And that was the argument then. Move forward a few years, another 2 years, conversation moved on to, well, I need to own the file. Right? I need to own the file on my laptop, and what you're proposing is a virtual thing. And I know the two are very different, but just the mindset changes very, very quickly. When was the last time somebody, when they were watching a Netflix movie to you, said, hey, you know what I really miss is those 600 DVDs cluttering up this cabinet. It doesn't happen anymore, right? So that is moving. Yes, money is very, very different, but you're walking around with your credit card. You're walking around with, ultimately, apps on your phone. I think Starbucks accounts for X amount of transactions, a significant percentage now being done on their mobile. That is money. That's not, you're not feeling that. It's a virtual app or virtual system taking place. You walk into Starbucks, people quite easily pull out their phone, scan it, and pay for a coffee. Bitcoin is not much different than that.
Got it. Got it. And what are some of these things? Like, for instance, if we had a big bracket bank start to do research on Bitcoin this year and start publishing, would that make it easier for the financial?
I think we've already seen that. Bank of America Merrill Lynch just published a report about a week ago, and let's face it, whether they come out publicly, admit it, every large corporation and every financial institution is looking into Bitcoin. I see it from the number of inquiries we get, one from institutions in the finance space, and whether that's the large consumer ones or whether it's hedge funds or private equity funds, because it's very significant to any finance industry. Right? So you have that, and then two, from the actual retailers, whether it's Walmart or Target or UK high street chains, everyone's very realistically looking at this. So the reports are relevant. The key is who's writing the reports. I mean, the only thing I would say is CoinDesk, for me, was a way of myself getting information. There wasn't anywhere I could go and get information, and I said, well, maybe I should launch something. And 7 or 8 months later, we're one of the largest sources of Bitcoin information in the world, and I will put my hand up and say, I am just slightly less ignorant than everyone else about it, because it's changing so fast.
Yeah.
So an analyst who just got into it 2 weeks ago and issues a report, I think is actually misleading their customers, because there's a lot more to it than just somebody spending a few hours on the web and going, hey, here's my financial analysis on the topic. I'd be keen to hear from our esteemed economic historian on the topic.
Well, my first career actually was in an investment bank, so it was quite interesting to see not just Bank of America, but another bank down in Los Angeles,
Wedbush,
also initiate the first, I think, broker-dealer valuation model for Bitcoin, and they looked at Bitcoin as a possible disruptor to payments and a store of value, and came up with a price target, a price range based on adoption rates and time frames of anywhere between $10,000 and $100,000 for Bitcoin. So, the Wall Street is starting to pay attention to Bitcoin, I think, is the bottom line. And if some of these ecosystem companies take off, which VCs are backing and want to go public, that's going to be a whole other reason for Wall Street to get interested in Bitcoin.
Are there some shocks to the system that could take place that would bring Bitcoin to the spotlight of the world, like another Cyprus or...
Absolutely. We're here in France. I don't have to tell the folks inside the European Union that the European sovereign debt crisis is not completely resolved. There's a lot of questions about what's going to happen next, when the next shoe is going to drop. Countries like Greece certainly still have a very large high level of debt, and we don't know what's going to happen. The IMF, the International Monetary Fund, recently came out and said that the reintroduction of capital controls could make sense under certain scenarios. Bitcoin helps bypass capital controls. Anyone who's interested in financial freedom and, say, protecting their savings should certainly be interested in Bitcoin, especially knowing the changing regulatory environment that we're in right now.
In the same way they might be interested in gold.
Absolutely. With gold, though, has significant costs associated with it. You've got to store it, you've got to protect it. It's difficult to move. So Bitcoin does away with a number of those, and you've seen gold prices relatively flat for quite a long time. They've come down even quite a bit. One possibility is the people who were looking at gold as a safe store of value have actually started to look at Bitcoin.
Mm-hmm. I think a lot of it also depends on the different types of people we're talking about. So Chamath, ex-Facebook, now runs Social Capital, big believer in Bitcoin, and his attitude was, in my opinion, anyone with significant wealth or wealth of a certain amount should be willing to put 1% of their net worth into Bitcoin. So, you're worth 100 million and you put 100, or, you put 1 million in, the risk to reward, or reward to risk, put that on one side. The danger comes, and this is what I'm seeing more and more, is people who don't necessarily understand it and are jumping on it purely, not even understanding what Bitcoin is, going, hey, 12 months ago today it was 13 or 14 and it's gone up 70x or whatever. This is a quick and easy way to make money. And they don't have wealth put aside anyway, because like most of the world, they're working people and they have a certain amount put aside. They're borrowing money on their credit cards or from their banks in this get-rich-quick scheme. That's where the worry for me comes. And as we know, it's usually those people who are left burnt at the end of anything significant like this. If you're understanding it, if you're an entrepreneur or you're a risk taker, why wouldn't you do it? If you're speculating in gold or using it as a safety nest of some kind, if you had put in $1 million a year ago, that would be worth close to 70 or 80 million dollars. And I think that's one of the things that really worries me going forward.
So what are the risks? Imagine a year from now we're not talking about Bitcoin anymore because it died or it became irrelevant. What would cause that to happen? Anything at this point?
Well, if you look at what happened in China, for example, they did not try to terminate Bitcoin, unlike what they did with QQ, and it's argued that one of the reasons they may have taken a more nuanced regulatory stance is because they may not be able to kill Bitcoin. It's not centralized like QQ is. So there's some question about whether it really can go away given its decentralized nature. Having said that, there's certainly a number of risks which Bitcoin faces. People are focused on the regulatory side of things. As an economic historian, I can tell you that alternative currencies like Bitcoin are nothing new. They've been around for hundreds of years, if not longer. And by far and away, the more common cause of death for alternative currencies is not regulation, although that does kill off a few. It's either technological advances or insufficient demand. And if you look at Bitcoin, it already takes 10 minutes or more for the blockchain to update after each transaction. There's other cryptocurrencies that have come along since that update much more quickly. On the demand side of things, James, you mentioned Litecoin. One of the interesting angles to the Litecoin story is the fact that the founder decided not to retain any of the Litecoins once he created that currency. And that's given that currency a bit of a kind of an altruistic halo, if you will, effect. You could see people maybe looking at Bitcoin and saying, this mysterious Satoshi Nakamoto character, who is he? He's a billionaire now. Maybe we want to make Litecoin our preferred currency for some kind of social reason. So there are some risks out there that could disrupt Bitcoin.
So social emotional dynamics come in, much like they would for a product like iPhone or, something that didn't take off.
Yeah.
Interesting.
I mean, what is interesting is I've spoken on a number of these panels, and I did the Bitcoin panel last year and asked the audience, how many people had heard of Bitcoin. And there's probably 40%. How many people had bought a Bitcoin? It was less than 10%. And I was thinking outside, what we should really do is come out here and go, who hasn't heard of Bitcoin? Because Loic alone has talked about it enough, but you look at BBC, you look at CNN, everyone's been running enough news articles on it over the last few months that there's various tipping points that we're going to hit.
Yeah.
What is interesting in terms of the emotional element is, there's a room here of very smart technologists and people who are normally at the forefront of technology. If we're sitting here educating them and educating us at the same, or educating ourselves at the same time, look at the gap between this and mainstream adoption. So the emotional part, there's still a big divide of the education process and the news filtering down to what Bitcoin actually is.
Right, and one of the things I've heard people say emotionally is, what's it backed by? It's just a digital thing in the nothing. It's in that internet thing. What's it backed by? So what is backing Bitcoin and what backs normal currencies?
Well, money is a rather abstract thing to begin with. It's, at least in the U.S., it's not taught how money even comes into existence. So if you ask people, what is money, you get a kind of sometimes a perplexed look. And Bitcoin takes it a step further because there's no coin and notes. But the important thing to know about any currency, even national currencies, is that they're fundamentally backed by supply and demand. Without demand for them, there's really nothing there. A government can force you to pay taxes in a currency, and that's argued as what backs, say, a fiat currency like the euro, like the dollar. But it's still subject to demand. Zimbabwe forced people to pay taxes in its currency, and it eventually, that currency went away, and now the dollar has replaced it. So these currencies that we use every day aren't so different than Bitcoin in terms of their fundamentals, I would say.
Right,
yeah.
Right. So with any new technology, it usually has natural enemies and natural allies. Who are the natural allies? Who are the people who are going to try to bring Bitcoin and other math-based currencies to the world? And who are the people who are going to try to stop it? Who are the people who are threatened here?
Well, if you look at governments to an extent, and I think there's a number of different parties, but governments can be allies and they can be the enemies, purely from a lack of understanding. From an allied point of view, let's face it, the financial systems are broken. There's no doubt about that. Some of the infrastructure being used is 10, 20, 30 years old. It needs to move with the times.
And those banks are making a lot of money using that archaic system.
Yeah.
What were you telling me about London and clearing a check in London?
Yeah, absolutely. So, the costs involved there. And at the same time, there's this opportunity, right? That this next generation, and I know this may seem very crazy, but if people are accepting that music and videos can be played over this thing called the cloud, and they're growing up not with a piggy bank where their grandmother gives them some cash and they put it in there and it's money in their app store as such, this virtual destination where they can buy stuff from, then suddenly virtual currency isn't very different. Do the governments want to embrace this? Absolutely. To me, I think it's just purely a lack of understanding, which is how it ends up being people in two different camps. That's one side of it. Then you've got the financial institution, where I think they suffer from the same thing. And I know me and Garrick talked about it earlier on. Garrick can share that, is the opportunities they see and also the risks and challenges because they're making so much money. Visa, for example, I think, is watching this very, very closely.
Right, right. So any enemies, any people who we can expect to come and help this happen?
Well, I think, on the friend side of things, I think consumers and businesses are, form a powerful alliance. Any business that does a high volume, low margin trade, think of a grocer, think of, someone operating in agriculture, is looking at Bitcoin and saying, this can really help me save, say, 3% that I'm charged on my Visa and MasterCard transactions. Consumers, certainly are interested in saving money, obviously. People, as we've talked about, looking to send money abroad. I mean, I know from when I was in Tanzania, sometimes it can take, a transfer through 3 banks in several days to get funds into parts of Africa. Bitcoin completely flattens that. So there's certainly some powerful allies, but I mean, I think the only certain enemy, Shaq mentioned governments could be both friends and enemies, but the only certain enemies are probably the kind of the holders of the keys to the current payment system, the Visas, the MasterCards, the Western Unions. I think Bitcoin does threaten them, but everyone else, I think, stands to gain quite a bit.
Okay. Is there room for more than one currency, or is it a winner-take-all? Right now we're seeing number 2 is 1/10 the size, and number 3 is 1/10 the size of number 2. What?
So, from a personal point of view, I have no idea, and I don't want to make any predictions where it ends up. What is obvious is that there is a need for something like Bitcoin. Who knows whether in 2 years' time or years' time Bitcoin is even relevant, but some of the fundamental thinking that went behind it has been used for something new. I honestly don't know where it ends up. What I do know is if you look at Bitcoin versus every other coin out there, the demand, the awareness of it, and the transaction volume taking place, it seems like Bitcoin's the winner. But then if you go back to the web and look at Internet Explorer and Netscape Navigator and some of those companies, you go back before that, VHS and Betamax, this carries on, right? So you've got the Apple ecosystem, the Android ecosystem, who really knows? So I don't think there is a definitive answer to give on that. And I'll come back to, I just know slightly more than the people in this room, and I'm sure there are people in this room who know far more about it. We're just in such a fascinating, fast-moving space right now that making any predictions are going to be irrelevant, in my opinion.
Yeah. Is there any lesson from history we can take about multiple currencies or anything?
Well, I mean, prior to the kind of explosion in cryptocurrencies we've seen recently, there was estimated there were some 4,000 alternative currencies around the globe. So certainly there's lots of room for alternative currencies out there, and throughout history that's been the case. Having said that, I mean, I think part of the reason you've seen, Peter Thiel, Fred Wilson, Mark Andreessen, Jim Breyer, and others really focus their investments on Bitcoin, or companies that can really focus on Bitcoin for now, is that this is an uphill battle that Bitcoin's fighting. It's going to be a long, hard road potentially. As far as it's come already, it's still got a lot to go. And I think you need to see kind of a focus on a one currency like we're seeing right now to kind of get this moving into a sustainable position.
It's got the brand value, it's got the ecosystem, it's got the momentum.
Critical
Let's
mass.
get behind a critical mass. It's hard to do, right? It doesn't happen often.
Yep.
And so speaking of those venture guys, what companies are the most interesting companies out there that you guys see? The ones that have been backed, or the ones that have not yet been backed?
So I'm an investor in BitPay, so we have to leave that one to the side.
Okay.
I think the most fascinating companies in the digital currency space are being built right now. I have no idea where they are, but if you look at the last 12 months, what has come out and what is required, and the renewed interest from institutional investors, that they've missed the first wave, and maybe there was the right thing, maybe there was the wrong thing. These companies are being built and funded right now. I think Q1, Q2 we'll see a few of these starting to surface. Circle, which is backed by General Catalyst and Accel, and has got Jeremy Allaire, the founder of Brightcove, behind it, seems to be the first one of this batch. And
this is the second generation of companies.
This is the second generation.
Yeah.
And what is also required, apart from the technology solution, is also the consumer trust and the branding effect. And I don't mean to discount that in any way, but you're talking about somebody creating a wallet and expecting you or I to put in 10,000 or 100,000 or 1,000, whatever is relevant, into something. You need some sort of consumer protection and consumer trust, and that comes with not just having lots of money backing it, but building a consumer brand and actually getting the trust of the end user there. things that have been happening this year, and there's, you hear every day or every week that, oh, so-and-so got hacked and so-and-so lost their coins. It wasn't the Bitcoin system or the protocol that was the problem here. It's basically somebody putting their money in a bank which was run by somebody who had full intention of running away with their money.
Yeah. Yeah. Any companies that you're seeing that, because there's a bunch of exchanges. Most of the companies that have been backed by venture guys are exchanges / wallets, right?
Mm-hmm. Most of the companies that are being shut down are also exchanges.
Most of the companies shut down are exchanges, right?
Well, I think we should plug Shaq's company, CoinDesk, for just a second here. One of the big problems with Bitcoin and trying to study it is the data is not that great right now. We don't know, say, for example, what the price of Bitcoin is. Is it the Chinese price? Is it the one at Gox? Is it at another exchange? So I really applaud what CoinDesk is doing with their Bitcoin price index and trying to bring more transparency and visibility into some of these data questions. How many Bitcoins are being exchanged for merchant transaction goods and services versus traded? There's a lot of unanswered questions on the data side. So, companies like CoinDesk are doing, I think, good work in trying to help there.
We got together before, and just sort of as a we've got 30 seconds left, just to give you a sense of some of the resources you all can go to if you're interested. The VCs that have stated explicitly they're looking at this are Ribbit Capital, BitAngels, Lightspeed, Union Square, Y Combinator, and Boost Incubator. And then there's a bunch of supporting companies that are supporting the ecosystem, starting with CoinDesk. And then there's a company called Ripple and Dwala, who are both intermediaries. Silicon Valley Bank is developing expertise in this. 2 law firms, Perkins Coie and Paul Hastings, are very hot on this. And there's another group in San Francisco called Promontory that is a real expert in this whole area. So these are some resources that you can go to if you're thinking of starting a company in this area. So with 5 seconds left, should the people in this audience be investing in Bitcoin?
I answered that earlier on. Depends how much of your wealth you're willing to risk. Should somebody be leaving here and going, hey, I can make 100x on this and this is a quick way to make money? Absolutely not.
Not.
If you believe in the fundamentals of Bitcoin and digital currency and you're willing to take a certain risk, but first and foremost expect that the downside is 0. You could lose every single dime.
Everything.
Accept that and move on. Come back to that. The biggest worry is people getting into Bitcoin, not having any understanding what it is, but purely going, hey, my buddy John's programmer, geeky friend, made $4 million in the last 12 months, and I need to get into this. And that is starting to happen, and that will happen more and more.
Got it. Thank you, guys. This has been great. Appreciate it.
Great. Thanks, James.
Thank you, guys.
All right. Thank you.
Thank you. I have no Bitcoin. I regret. I was told to buy them, 6 months ago.
What is Bitcoin? Bitcoin is the first decentralized digital currency. Bitcoins are digital coins you can send through the internet. Compared to other alternatives, Bitcoins have a number of advantages. Bitcoins are transferred directly from person to person via the net, without going through a bank or clearinghouse. This means that the fees are much lower, you can use them in every country, your account cannot be frozen, and there are no prerequisites or arbitrary limits. Let's look at how it works. Bitcoins are generated all over the internet by anybody running a free application called a Bitcoin miner. Mining requires a certain amount of work for each block of coins. This amount is automatically adjusted by the network such that Bitcoins are always created at a predictable and limited rate. Your Bitcoins are stored in your digital wallet, which might look familiar if you use online banking. When you transfer Bitcoins, an electronic signature is added. After a few minutes, the transaction is verified by a miner and permanently and anonymously stored in the network. The Bitcoin software is completely open source, and anybody can review the code. Bitcoin is changing finance the same way the web changed publishing. When everyone has access to a global market, great ideas flourish. Let's look at some examples of how Bitcoins are already used today. You can purchase video games, gifts, books, servers, and alpaca socks. Several currency exchanges exist where you can trade your Bitcoins for dollars, euros, and more. Bitcoins are a great way for small businesses and freelancers to get noticed. It doesn't cost anything to start accepting them, there are no chargebacks or fees, and you'll get additional business from the Bitcoin economy. For your first Bitcoins and more information, visit weusecoins.com.
The goal of this video is to explain how Bitcoin works under the hood, to give a clearer idea of what it really means to own, send, or mine Bitcoins. First, a brief high-level overview of what Bitcoin is. At its core, Bitcoin is just a digital file that lists accounts and money like a ledger. A copy of this file is maintained on every computer in the Bitcoin network. These numbers don't represent anything in the physical world. They only have value because people are willing to trade real goods and services for a higher number next to their account and believe others will do the same. The numbers only have value because we believe they have value, just like any other fiat currency. To send money, you broadcast to the network that the amount on your account should go down and the amount on a receiver's account up. Nodes or computers in the Bitcoin network apply that transaction to their copy of the ledger and then pass on the transaction to other nodes. This, with some math-based security, is really all there is, a system that lets a group of computers maintain a ledger. While this may sound similar to the way a bank maintains a ledger, the fact that the ledger is maintained by a group rather than a single entity introduces a number of important differences. For one, unlike a bank where you only know about your own transactions, in Bitcoin everyone knows about everyone else's transactions. Also, while you can trust your bank, or you can at least sue it if something goes wrong, in Bitcoin you're dealing with anonymous strangers, so you shouldn't trust anyone. The Bitcoin system is amazingly designed so that no trust is needed. Special mathematical functions protect every aspect of the system. The rest of this video will explain in detail how Bitcoin allows such a group of strangers to manage each other's financial transactions. At a basic level, for Alice to send money to Bob, she simply broadcasts a message with the accounts and the amount. Send 5 Bitcoins from Alice to Bob. Every node that receives it will update their copy of the ledger and then pass along the transaction message. But how can nodes be sure that the request is authentic, that only the rightful owner has sent the message? Bitcoin rules require a kind of password to unlock and spend funds, and this password is what's called a digital signature. Like a real handwritten signature, it proves the authenticity of a message, but it does so through a mathematical algorithm that prevents copying or forgery in the digital realm. Unlike a simple static password, a completely different digital signature is required for every transaction. Keep in mind that in Bitcoin, you're dealing with complete strangers, so you never want to reveal a password that could be copied and reused by someone else. A digital signature works by utilizing 2 different but connected keys, a private key to create a signature and a public key that others can use to check it. You can think of the private key as the true password and the signature as an intermediary that proves you have the password without requiring you to reveal it. Public keys are actually the send to addresses in Bitcoin, so when you send someone money, you're really sending it to their public key. To spend money, you must prove that you're the true owner of a public key address where money was sent, and you do that by generating a digital signature from a transaction message and your private key. Other nodes in the network can use that signature in a different function to verify that it corresponds with your public key. Through the math behind the digital signature, they are able to verify that the sender owned a private key without actually seeing the private key. Importantly, because the signature depends on the message, it will be different for every transaction and therefore can't be reused by someone for a different transaction. This dependence on the message also means that no one can modify the message while passing it along the network, as any changes to the message would invalidate the signature. The math behind this is fairly complex, and while I won't try to explain it fully now, here are some topics you can Google to get started. Elliptic curve digital signature algorithm and mathematical trapdoor. More at the end of the video. So far, we know that digital signatures are used to ensure a transaction is authorized, but I've oversimplified how nodes in the network keep track of account balances. In fact, no records of account balances are kept at all. If you don't keep track of how much money any given person has, how do you know if they have enough to send to someone else? Instead of balances, ownership of funds is verified through links to previous transactions. Here's how this works. To send 5 bitcoins to Bob, Alice must reference other transactions where she received 5 or more bitcoins. These reference transactions are called inputs. Other nodes verifying this transaction will check those inputs to make sure Alice was in fact the recipient, and also that the inputs add up to 5 or more bitcoins. Let's look at a real transaction to see this in practice. This transaction references 6 inputs for a total of 139.6 bitcoins. In the output section, notice that there are 2 lines. The first one of these is actually going back to the sender as change for the transaction. A simplifying rule states that each input must be used up completely in a transaction. So if you're trying to send an amount that doesn't exactly match one of your inputs, you need to send any remaining amount back to yourself. Through these reference input linkages, ownership of bitcoins is passed along in a kind of chain, where the validity of each transaction is dependent on previous transactions. But how can you trust those previous transactions? You can't, and you should check their inputs too. In fact, when you first install Bitcoin wallet software, it downloads every transaction ever made and checks each one's validity all the way back to the very first transaction. Remember, you're dealing with complete strangers, so it's important to verify every transaction for yourself. This process can take over 24 hours, but it only needs to be done once. Once a transaction has been used once, it is considered spent and cannot be used again. Otherwise, someone could double spend an input by referencing it in multiple transactions. When verifying a transaction, in addition to the other checks, nodes also make sure that inputs haven't already been spent. To be explicit, for each input, nodes check every other transaction ever made to make sure that input hasn't already been used before. While this may seem time-consuming, as there are now over 20 million transactions, it's made fast with an index of unspent transactions. So instead of a ledger of balances, Bitcoin nodes keep track of a giant list of transactions. Owning Bitcoins means that there are transactions in this list that point to your name and haven't been spent, or in other words, used as inputs in other transactions. One interesting consequence of this ownership structure is that figuring out your own balance requires iterating through every transaction ever made and adding up all your unspent inputs. Another interesting note about transactions is that the system can support more complex ones than simply sending funds to one person. You may have noticed a cryptic-looking line of text in the output shown previously. It turns out that outputs are more like puzzles to be solved rather than simple to addresses. Rather than emailing, sending money in Bitcoin is more like putting money in a public locker and attaching a math puzzle that must be solved to open it. The puzzle is defined using a special scripting language, and while it's typically designed so that only a single owner of a public key can solve it, more complex conditions are possible. For instance, 2 out of 3 signatures could be required for an escrow-based transaction. Another example is the very first Bitcoin transaction ever made, which was a puzzle that anyone could solve. While most Bitcoin software hides the scripting layer for you, you're free to write your own software and claim conditions, although this can be risky. Over 2,600 Bitcoins were lost in one batch of transactions due to a malformed address. This highlights an important part of Bitcoin. As there is no bank or credit card company you can appeal to, any user error mistakes can result in permanent loss of Bitcoins, and not just from your own account, but from the Bitcoin economy overall. If you lose your private key, any funds associated with the corresponding public key will be gone forever. Because people will likely lose private keys due to hard drive crashes and insufficient backups, this means the Bitcoin currency will eventually be a deflationary one. Before explaining the final piece that secures Bitcoin, mining, I want to highlight a few points about anonymity in Bitcoin. If you access Bitcoin through a Tor network that hides your IP address, you can use Bitcoin without ever revealing anything more than your public key. And to avoid someone linking your transactions together, remember they're all publicly stored on every computer, you can generate a new public key for every incoming transaction. It is possible, however, to inadvertently link public keys together. In the transaction shown earlier, 6 input transactions were used as sources, and despite the fact that all those inputs were sent to different addresses, they all became linked in that transaction. The sender proved that he owned all of those addresses by supplying the digital signature to unlock each one. Researchers have in fact used these links to study Bitcoin user behavior. You might think that generating a public key receiving address could potentially create a link to your true identity, but even this step is anonymous and amazingly can be done with no connection to the network. You simply click a button in your wallet software and it randomly generates a new private and public key. Because there are so many different possible addresses, there's no reason to even check if someone else already has that key. Compare this to signing up for an email address where almost everything you might try has been taken. In fact, if you did guess someone else's key, you would have access to all their money. This is the total number of possible Bitcoin addresses. These large numbers protect the Bitcoin system in several ways, so it's useful to try to appreciate just how big they are. Some estimates for the number of grains of sand in the entire world are around 7.5 million trillion. Now imagine that every grain of sand represented an entire other Earth of additional grains, and you're still much smaller than the possible number of Bitcoin addresses. Let's recap Bitcoin's security so far. By verifying the digital signature, we know that only the true owner could have created the transaction message. And to make sure the sender actually has money to spend, we also check each referenced input, making sure it is unspent. But there is still one large security hole in the system that can make this unspent check unreliable, and this has to do with the order of transactions. Considering that transactions are passed node by node through the network, there's no guarantee that the order in which you receive them represents the order in which they were created. And you shouldn't trust a timestamp because someone could easily lie about the time a transaction was created. Therefore, you have no way to tell whether one transaction came before another, and this opens up the potential for fraud. A malicious user, Alice, could send a transaction giving money to Bob, wait for Bob to ship a product, and then send another transaction referencing that same input back to herself. Because of differences in propagation times, some nodes on the network would receive the second double spending transaction before the one to Bob. And when Bob's transaction arrived, they would consider it invalid because it's trying to reuse an input. So Bob would be out both his shipped product and his money. Overall, there would be disagreement across the network about whether Bob or Alice had the money because there's no way to prove which transaction came first. In light of this, there needs to be a way for the entire network to agree about the order of transactions, which is very much a daunting challenge in a decentralized system. Bitcoin's solution is a clever way to both determine and safeguard the ordering through a kind of mathematical race. The Bitcoin system orders transactions by placing them in groups called blocks and linking those blocks together in something called the blockchain. Note that this is different from the transaction chain we discussed earlier. The blockchain is used to order transactions, whereas the transaction chain keeps track of how ownership changes. Each block has a reference to the previous block, and this is what places one block after another in time. You can traverse the references backwards all the way to the very first group of transactions ever made. Transactions in the same block are considered to have happened at the same time, and transactions not yet in a block are called unconfirmed or unordered. Any node can collect a set of unconfirmed transactions into a block and broadcast it to the rest of the network as a suggestion for what the next block in the chain should be. Because multiple people could create blocks at the same time, there could be several options to choose from. So how does the network decide what should be next? We can't rely on the order that blocks arrive because, as explained with transactions above, they may arrive in different orders at different points in the network. Part of Bitcoin's solution is that each valid block must contain the answer to a very special mathematical problem. Computers run the entire text of a block plus an additional random guess through something called a cryptographic hash until the output is below a certain value. A hash function creates a short digest from any arbitrary length of text. In our case, the result is a 32-byte number. Here are some examples of the specific hash function Bitcoin uses, SHA-256. Note how much the output changes in result of a single extra period at the end of the third example. The output is completely unpredictable, so the only way to find a particular output value is to make random guesses. It's very much like guessing the combination to a lock. You might get lucky on your first guess, but on average it takes many guesses. In fact, in Bitcoin, it would take a typical computer several years of guessing to solve a block. With every computer in the entire network all guessing numbers, it takes about 10 minutes on average for someone to find a solution. The first person to solve a math problem broadcasts their block and gets to have their group of transactions accepted as the next in the chain. The randomness in the math problem effectively spreads out when people find a solution, making it unlikely that two people will solve it at the same time. Occasionally, however, more than one block will be solved at the same time, leading to several possible branches. In this case, you simply build on top of the first one you received. Others may have received the blocks in a different order and will be building on the block they first received. The tie gets broken when someone solves the next block. The general rule is that you always immediately switch to the longest branch available. The math makes it rare for blocks to be solved at the same time, and even more rare for this to happen multiple times in a row. The end result is that the block chain quickly stabilizes, meaning that everyone is in agreement about the order of blocks a few back from the end of the chain. The fact that there's some ambiguity in the end of the chain has some important implications for transaction security. For instance, if your transaction finds itself in one of the shorter branches, it will lose its place in line within the block chain. Typically, this just means it will go back to the pool of unconfirmed transactions and be included in a later block. Unfortunately, this potential for transactions to lose their place opens the door to the very double-spend attack that was our original motivation for an ordering system. Let's look at how a double-spend attack would work in the system described so far. A fraudster, Alice, sends money to Bob. Bob then waits for the transaction to get confirmed into the blockchain and then ships a product. Now, because nodes always switch to a longer branch, if Alice can generate a longer branch that replaces the transaction to Bob with one to someone else, his money will effectively get erased. Bob's transaction will initially get tossed back into the unconfirmed pool, but since Alice has replaced it with another transaction that uses its same input, nodes will now consider Bob's transaction invalid because it's referencing an already spent input. So how does the ordering system prevent Alice from defrauding Bob? You might think that Alice could pre-compute a chain of blocks to spring on the network at just the right time, but the math puzzles in each block actually prevent this. We need to look a little deeper into the cryptographic hash explained earlier to fully understand why. As mentioned previously, solving a block involves trying to get the cryptographic hash of the block to be below a certain value, and you do that by trying different random numbers at the end of the block. Once solved, the hash output is like a fingerprint that uniquely identifies that block. If even a single character in the block is changed, the block's hash would be completely different, just like we saw before when an additional period was added. The hash output, or fingerprint, is actually what's used as the previous block reference. One result of this is that there's no way to switch out a block in the middle of the chain, because the hash value for the new block would be different and the next block's reference would no longer point to it. And subtly, but even more importantly, a block cannot be solved before the previous block is solved. The previous block reference is part of the text that goes through the hash function, so any changes to it would require resolving. Getting back to Alice, this is why she can't pre-compute a branch. She can only start solving blocks once the block she wants to build on is solved and its hash value is known. She is therefore in a race with the rest of the network until Bob ships a product, which is when she wants to present a longer branch. One last question is whether Alice might be able to outpace everyone if she had an extremely fast computer, or perhaps a room full of computers. But even with thousands of computers, she would be unlikely to win the race to solve a block because she isn't racing any one computer, but rather the entire network. You can think of it like a lottery. She can operate thousands of computers, or equivalently buy thousands of lottery tickets, but even then, it's much more likely that someone else would win. She would need control of half the total computing power in the entire network to have a 50% chance of solving a block before someone else, and much more to have a high probability of winning several blocks in a row faster. So transactions in the blockchain are protected by a mathematical race, one that pits an attacker against the entire rest of the network. A consequence of blocks building on top of each other is that transactions further back in the chain are more secure. An attacker would have to outpace the network for a longer amount of time to carry out a double-spend attack, replacing a block further back in the chain. So the system is only vulnerable to a double-spend attack near the end of the chain, which is why it's recommended to wait several blocks before considering received money final. One last comment on the blockchain before explaining the final pieces of the Bitcoin system. Amazingly, nothing described so far requires any trust. When you receive information from strangers in the Bitcoin network, you can check for yourself that block solutions are correct. And because the math problems are so hard, you know that there's no way any attacker could have generated them on their own. The solutions are proof that the computing power of the entire network was brought to bear. Now that we've discussed how money is transferred through digital signatures and transaction chains, and how the order of those transactions is protected in the blockchain, let's go over the final piece, where Bitcoins come from. To send money, you must reference a previous transaction where you were the recipient, but how do coins get into this ownership chain in the first place? As a way to slowly and randomly generate and distribute coins, a reward is given to whoever solves a block. This is why solving blocks is called mining, although its real purpose is to verify transactions and safeguard the blockchain. Every 4 years, the block reward is cut in half, so eventually no more coins will be released. About 21 million in total will be created. Bear in mind that you can send down to 1/100 millionth of a Bitcoin, so the total number available will likely not limit the currency's usability. Once the block rewards cease, what incentive will miners have to process transactions? In addition to the block reward, miners also get any transaction fees that can optionally be included with transactions. Right now, miners will include transactions with no fees into blocks because their main incentive is the block reward. But in the future, transactions will likely be processed in order of the fees attached, and ones without fees will likely be ignored. So sending money in Bitcoin will probably not be free, but will hopefully still be cheaper than current credit card fees. As mentioned before, on average, it would take several years for a typical computer to solve a block, so an individual's chance of ever solving one before the rest of the network, which typically takes 10 minutes, is very low. To receive a steadier stream of income, many people join groups called mining pools that collectively work to solve blocks and distribute rewards based on work contributed. These act somewhat like lottery pools among coworkers, except that some of these pools are quite large and comprise more than 20% of all the computers in the network. The fact that some of these pools are so large has some important implications about security. As mentioned before, it's very unlikely for an attacker to solve several blocks in a row faster than the rest of the network, but it is possible, and the probability increases as the attacker's processing power gains in proportion to the rest of the network. In fact, one of these mining pools, BTC Guild, has solved 6 blocks in a row by itself and has voluntarily limited its members to ward off distrust in the entire Bitcoin network. Even with substantial computing power, the farther back in the blockchain a transaction gets, the harder it would be for an attacker to change it. The current recommendation is to wait for a transaction to make it into at least one block or get one confirmation before considering it final. And for larger transactions, wait for at least 6 blocks. In light of BTC Guild's ability to solve 6 blocks in a row, you might want to wait even longer. By design, each block takes about 10 minutes to solve, so waiting for 6 blocks would take about an hour. Compared to the several seconds a credit card transaction takes, waiting this long for a confirmation may seem burdensome, but keep in mind that credit card customers can claim a stolen card months later to have charges reversed from merchants, called chargebacks, so Bitcoin is actually much faster from a merchant's perspective. The particular choice of 10 minutes was somewhat arbitrary, but extremely short times could lead to instability and longer ones would delay confirmations. As more computers join the network and specialized hardware is designed specifically for mining, the block solution time would get very small. To compensate, every 2 weeks, all the Bitcoin software recalibrates the difficulty of the math problem to target 10 minutes. For comparison, a similar digital currency called Litecoin has been able to operate with a 2.5-minute block time. In summary, Bitcoin is a mathematically protected digital currency that is maintained by a network of peers. Digital signatures authorize individual transactions, ownership is passed via transaction chains, and the ordering of those transactions is protected in the blockchain. By requiring difficult math problems to be solved with each block, would-be attackers are pitted against the entire rest of the network in a computational race they are unlikely to win. Bitcoin promises many interesting ideas, such as insulation from government meddling, anonymity, and potentially lower transaction fees. It also has many challenges, as it is currently very difficult to exchange Bitcoins for other currencies, and it has been cited as a haven for illegal activity and tax evasion, so governments may try to ban it. Also, the mathematical race that protects the blockchain uses a substantial amount of electricity. If you'd like to view a written version of this video, you can find one on my personal blog, imponderableThings.com. The blog also has some additional explanations of the math behind the digital signatures and cryptographic hashes that underlie the system.